Welcome back to 1 hour of macro. I'm Zoltan Szelyes, based in Switzerland. In this format, Martin Tixier and I discuss key macro topics with global experts. After our successful launch in July with Louis Vincent Gave, we are back with another episode. Japan is getting more attention in global macro. The rise in interest rates and the weaker yen have raised some concerns. Japan is also in the focus because of its holding of treasuries. Despite its importance, there is still little understanding of the Japanese economy and its consequences in the global macro circle. Today, we are shedding light on this topic with Takuji Okubo, a key expert on Japan macro, joining us from Tokyo.
Thank you very much, Zoltan. And Takuji, it's a great honor for us to have you having this discussion for an hour about Japan, which is such a profound subject that everyone seems to be an expert of without being an expert. And we thought it would be a great thing to have someone like you coming online to debunk a lot of fallacies and bad understanding of Japan, its debt situation, its fiscal trajectory. But first, I would like you to introduce yourself about where did you study, what did you do, about the start of your professional career so that our listeners can understand your background.
Thank you for inviting me to a podcast of yours. It's a pleasure. About myself, so my name is Takuji Okubo. So I graduated from Tokyo back in 1997. That's some time ago. That's before Euro was introduced. And I do remember, so I joined Goldman Sachs, and I do remember that one of the first chart I made was basically sizing up the Asian economy. So I realized that Japan is actually 4 times as big as China. So, I think most of our viewers can't really imagine Japan being 4 times bigger than China. But I'm just telling you that, 1997 is fairly far away. But it's been an interesting 30 years of economist career. So I will just talk very briefly about, the company I belong. So after Goldman Sachs, I studied abroad, took, some degrees, get back to Merrill Lynch. So that was Merrill Lynch. So before the merger and before the Lehman shock. And then I went through Lehman shock as a senior economist at Merrill Lynch. So that was a very interesting time. And then I moved on to SocGen, Société Générale, the French or European investment bank. And there I experienced the Euro crisis. That was fun too. And then I started Japan Macro Advisors, my independent boutique investment. So, between then, I have done some non-economist role, but I will spare the details.
Great. I would like to start because I read with great interest your latest publication on Japan Macro Advisors, where you talked about the misconception of gross debt to GDP, making a comparison between Japan, between different G7 countries, including Canada. And I thought it would be great of interest for our readers to break down the fallacy and the misperception of the net debt situation of Japan. And as such, I would like us to start with you to explain why the flying number of like the 250 to 240% gross debt to GDP of Japan is the wrong way of reading the situation of Japan, and that Japan, in effect, is not facing a debt crisis, but it's more akin to having issues with its fiscal situation. So the floor is yours, Takuji, if you can explain us why there's a misconception there.
Sure. So gross debt to GDP, I would say for the last 5 years, saying that Japan has 250% debt to GDP, and it's so much bigger than everybody else. So that has been kind of one slogan to basically persuade the audience who have the kind of a severeness of Japan's debt problem or debt crisis, often described by. So, it's a kind of a persuasive number, 2 times 250% of GDP, where other countries such as US, France, Germany, they all have, about 100%. In case of Germany, it's as low as below 70%. So, when you compare Germany 70% to Japan 250%, it does sound like Japan has a huge debt problem. And what I would say is that yes, Japan does have a debt problem, but then, but it's just one number. I mean, so there are many ways. It's like, Okay, when you want to assess somebody's credit worthiness, do you look at just the size of the debt? No, right? You look at what kind of income that person has, what kind of assets they have. If that person has a huge asset, basically having some sizable debt often doesn't really matter. So, but basically, my message is on that report is that gross debt to GDP is just one of a key indicator, and they are as important. They are indicators which are as important as a gross debt to GDP.
To hear. Also, I wanted to ask you in relation to gross debt to GDP and to ascertain Japan's situation. One of your paper was very interesting in showing that Bank of Japan equity holdings, equity portfolio has been offsetting the bond losses. And I think that's a very, very important factor that a lot of people are not aware of. They're only looking at the liability side, as you mentioned, but they're not looking at the asset side. Can you go into more details about how Japan has been managing this ALM exercise, this asset liability management for the last couple of years, because it's been quite impressive from that point of view?
So, quantitative easing has been mostly kind of painful experience for central banks. And then many countries tend to have a fairly negative view of quantitative easing. They tend to think it didn't really work and it only left a kind of negative legacy. So when they think about Japan, okay, Japan did the biggest quantitative easing. So, Bank of Japan must be suffering, as what this viewpoint miss is Japan has kind of a lot more experience in doing quantitative easing. The first time Japan had to do some quantitative easing was back in 2001. So the latest one, starting in 2013, was actually the third try. So Japan also did a kind of what they call comprehensive monetary easing in 2010. So it was actually that one, the second quantitative easing by Bank of Japan, when Bank of Japan decided to buy kind of more credit assets. So their credit corporate bonds and then Japanese equity ETF. So this need to be attributed to Governor Shirakawa. So Japan has kind of more famous BOJ governor, Kuroda, who Prime Minister Abe appointed in 2013. And he's a famous guy who did, huge quantitative easing, huge purchase of government bond. But then it was actually his predecessor, Governor Shirakawa. He's a kind of he's actually somewhat similar to Bernanke in the sense that he's a kind of a scholar, academic type kind of guy. But I think he was pretty brave enough in 2010 to basically try what he called comprehensive quantitative easing, which included the purchase of equity ETF. So since 2010, Bank of Japan has been purchasing equity, not a huge lot, not a huge amount every year, but then certain amount throughout. And then this has actually, and I think book value of, as I remember, book value of equity ETF on Bank of Japan's balance sheet is 37 trillion yen, which is less than I would say 6%, 7% of the total balance sheet. However, Bank of Japan has been quite lucky that this equity they have been accumulating, equity ETF they have been accumulating has tripled. So it's more than 100 trillion yen worth of equity sitting on Bank of Japan's balance sheet. That's about 20% of the balance sheet. And then, as you know, that a dividend yield can be higher than bond yield. So Bank of Japan is enjoying fairly significant equity dividend, and that's really helping the kind of negative legacy from quantitative easing. Martin?
Yes, no, it's quite interesting because I was reading in your latest papers on that subject that obviously, given the accumulation of JEBs on the balance sheet, people tend to forget that the coupon on the bonds which were accumulated by the Bank of Japan has been very, very low relative to some of the dividends paid by these ETF holdings, as you mentioned. And as such, people tend to forget that these losses, which are accumulating on the balance sheet of Japan, are in effect sterilized and neutralized by the earnings coming from the equity holdings, as you mentioned, which I think is a very, very important point.
Indeed. So I mean, the way QE costs to central bank is it's not necessarily the easiest concept to understand. But then basically, Bank of Japan was buying a long duration debt, such as like a 10-year bond at the very, very low interest rate. Now, 0.1% is what they call yield curve control. So Bank of Japan basically fixed 10-year bond yield at the time at the 0.1%. But then as Bank of Japan is now raising the policy rate, the kind of ongoing interest rate is now 1%. But then this 10-year bond Bank of Japan has bought, well, it's a fixed coupon, right? So it will continue to just only pay 0.1%. So there is actually a negative interest rate spread. Bank of Japan actually need to pay 1% while receiving much lower kind of average coupon on its government bond holding. So that's how central bank in many places, such as the Fed, the Bank of England, and also ECB, they suffer from this negative interest spread as they raise their policy rate. Martin?
Yes, I have a question. Is the Bank of Japan in a similar situation as some of central banks which have been in negative equity? I'm thinking about the Federal Reserve as well as the Bank of England.
Mhm. So Federal Reserve. So I think the first time Federal Reserve tried with kind of a quantitative was after the Lehman. So Chair Bernanke basically did what they actually called it credit easing rather than quantitative, and they basically focused on buying mortgage bonds, Freddie Mac, Fannie Mae, so which were being sold, which were being traded very cheaply during the Lehman. So I think I don't remember exact number, but then Federal Reserve actually did end up making handsome profit on these mortgage bonds they bought, and Fed also actually bought some bad assets. So there were few financial institutions which went bankrupt, right? And then Federal Reserve was there to basically buy what they call bad assets. So, and then I believe Federal Reserve also made a handsome profit on these bad assets they bought. So there are actually other example of central bank making profits out of the broad definition of contributing. But well, unfortunately, that wasn't the case for Bank of England. So I think Bank of England does have they separate the balance sheet, and then so they have a separate balance sheet from their main balance sheet for the quantitative for the bond they bought for the under quantitative easing, and they basically let national government of the United Kingdom pay for it. So Bank of England itself does not suffer direct loss from the quantitative easing, but then there's a kind of subtle sense of obligation Bank of England may be feeling toward the national government. So I think that's one of the reasons Bank of Japan basically devised this method of a quantitative easing so that when the economy recovers, yes, they may suffer the negative interest rates, but then they will enjoy a kind of dividend yield from the equity. So that's how they kind of balanced. Basically, so they basically did a kind of positive sum game. So by buying into equity when the price are depressed, so they are basically playing the lender of the last resort role, right? It's kind of expanded version of a lender of last resort. When nobody wants to take equity risk, it was unusual. But then Bank of Japan made a decision to feel that it is part of the central bank to basically safeguard the whole financial system. And then it made sense. Bank of Japan felt it's a right policy to buy equity ETF. So there are some other examples such as Hong Kong Monetary Authority. Back in late 90s, I think there was a East Asian crisis. So and at the time, Hong Kong Monetary Authority actually also decided to buy equity. So it's not unprecedented, but then obviously it is unusual. unusual kind of calculated risk. Bank of Japan started to take in 2010, and they're paying off now.
Yes. Also, what I thought was very interesting to explain to the people is the significant amount of quantitative tightening, which is taking place within Japan by the Bank of Japan. Because if my memory is correct, and correct me if I'm wrong, I believe it's to the tune of around 6% of GDP, the quantitative tightening, which is quite significant, and it continues to be taking place, which is in fact, as you mentioned in some of your articles, which is restoring the average maturity length, which was lost due to quantitative easing.
Mm-hmm.
Can you explain a little bit more to our listeners the size of the quantitative tightening, and when do you think, at what level it will end? What is going on basically with the Bank of Japan's balance sheet currently?
Right. So, the concept of quantitative easing, quantitative tightening is a little difficult to, understand. But then basically Bank of Japan basically decided to flood the market with liquidity, what the financial market considers as liquidity. Basically, it's a deposits or reserve at the Bank of Japan, belonging to private sector financial institutions. What often happen in a financial crisis is that, everybody's worried about payment risk. Everybody's worried that your counterpart, however huge or big that your counterpart is, you become worried that, okay, Merrill Lynch may go bust, right? Merrill Lynch was one of the big back in the Lehman shock days. But then, in those times, no investment bank were kind of safe from being being under speculative attack of being insolvent maybe a week later, 2 weeks later. And so when the market is in panic, that kind of panic, basically they sell everything. They sell any assets they have so that they accumulate the liquidity at the central bank. So they pile up the cash to make sure that, whatever happens, they can pay. So on the other side of this kind of rush to liquidity is basically assets are being sold. Every asset, government bonds, equity, corporate bonds, because financial institutions are so intensively focused on accumulating the reserve, they sold it. So unless central banks step in, these asset prices will plummet. So that's where quantitative easing come in. So central bank is basically there to basically absorb all these selling pressure. So that's basically how quantitative easing happens. So quantitative tightening is basically the reverse. So Bank of Japan is not selling government bonds or equity ETF in mass in any way. But then Bank of Japan is basically letting JGP mature. So when the bond reaches maturity, Bank of Japan will basically let the government repay the reserve. So in total, the size of the reserve will continue to decline. So Bank of Japan, I think at the peak, had about 600 trillion yen worth of reserve on its balance sheet. So that's about 100% of GDP. So it has now fallen by roughly a quarter. So it's down to 450 trillion yen. But then I think the landing point is about 200 trillion yen or even a bit less. So there's actually, and it has already taken about 2 years for Bank of Japan to reduce the reserve to this level. And I think Bank of Japan could soft land to kind of stability point in maybe 3 years time. So it's going to be another while until Bank of Japan finishes its quantitative tightening.
Talking about quantitative tightening, what is your assessment? What does the Bank of Japan prefer, quantitative tightening or interest rate increases?
Okay, so, quantitative tightening is a kind of preferred measure because that as long as this reserve is huge, Bank of Japan will need to actually pay policy rate to this reserve. And like I said, Bank of Japan has about 450 trillion yen of of reserve, Bank of Japan now need to pay 1% interest on this. So that's basically 4.5 trillion per year. And that's huge. That's actually so rather than raise a policy rate, so if the Bank of Japan raises its policy rate to 2%, basically the interest payment is going to be 9 trillion. It's a simple arithmetic, right? But then I think at the 9 trillion, it will be impossible for Bank of Japan to basically balance its profit and liability. And at 2% interest rates, policy rate, Bank of Japan will definitely be making sizable losses on its profit and liability. So I think Bank of Japan's preference is to kind of only slowly raise policy rate so that they will continue to reduce the reserve so that they will be paying policy rate not on 450 trillion of reserve, but then 400, 300. So the cost of the more quantitative easing proceed, the less the impact of from the rise in the policy rate. So, but coming back to your questions, Bank of Japan's preference is to only slowly, gradually raise policy rate while quantitative easing continues. And that has been the way Bank of Japan has been handling the exit for the last 2 years.
It's very interesting because there are like these two effects which you have highlighted. Also the effect on the balance sheet of the higher interest rates, and at the same time, if you then quantitative tightening, you are reducing your balance sheet actually. So you're taking actually these two effects a bit away and or slow it a bit down. So
right. Actually, one more interesting. So this is kind of more about bond market thing, but then Bank of Japan actually prefers steeper yield curve. Bank of Japan is still buying JGBs. So Bank of Japan is kind of reducing the size of a JGB purchase, but it is still buying. It is still buying at the rate of 2 trillion yen per month. So, but with a steep yield curve, basically the government bond Bank of Japan is buying every month actually pays back higher coupon for the JGB, right? So every month, every year goes by, low coupon maturity JGBs goes off from Bank of Japan's balance sheet, and then higher bond yield, higher coupon bond yields start to occupy the Bank of Japan balance sheet. So as BOJ continue to raise policy rate at a certain speed, the rise in the average coupon of a JGB will start to match the policy rate. And at that point, quantitative easing will start to cost nothing for the Bank of Japan. But then usually the rise in policy rate is moving faster than so Bank of Japan that they do prefer kind of slow and gradual policy rate hike. But the time is a cure for Bank of Japan.
Because as you mentioned as well in some of your presentations, Japan pays the least of the 5 most indebted G7 countries when it comes to the interest rate burden as a percentage of GDP. It's much lower, for example, than what it is in the United States per se, as you mentioned.
Yes.
So, yes.
Yeah. So that's right. So yes. So one of the key issue is, yes, the size of the debt matters for G7, and when it comes to size of the debt, well, Japan has by far the biggest. But then Japan also has actually the lowest interest payments on the debt, right? And it used to be near zero. So however big Japanese government's debt are, if the interest rate is close to zero, it doesn't really matter, right? But so it's not zero anymore, unfortunately for Japanese government. But then the policy rate is still at 1%. So the policy rate in US, in Europe. So 1% policy rate is pretty low. So that's why the interest rate payment burden for Japanese government is low. But there's actually a second reason. There's actually a second reason why the interest rate payment is low. It's because that the Bank of Japan, Japanese government bond has been issuing long-dated bonds. The longest bonds they issue is a 40-year. So for these long bonds, Japanese government issued back in 2020, they are still, coupon is the same. So even though 40%, even though 40-year JGB is now yielding 4%, the bond they issued back in 6 years ago is still at a very low coupon. So that's also helping the interest rate payment burden for the Japanese government.
On top of, I would add as well that as you shown before, on top of that, Japan is second to United Kingdom when it comes to the average maturity of its government debt portfolio, which is quite helpful in that sense relative to the US, which is issuing more and more short-dated treasury bills. Like 85% of new issuance for the United States are treasury bills, on top of having a average duration around 5.8, as you mentioned. So it's not the same risk profile as you mentioned because of the low interest expense for the Bank of Japan.
Yes. So yeah. So I mean, so this is a complex issue. Whether we think Japanese government just as a single entity, or whether you actually consider its central bank as a kind of a consolidated entity. So like I said, central bank used to pay nothing for the reserve. So basically all they do is they print money, for which they don't owe any interest. And also for the reserve, they didn't owe anything. So basically central bank didn't have any cost attached to it. But now after the QE, they basically started to pay interest on the reserve. So now we could consider reserve as a kind of a debt. And now since now it's a debt, there are people, correctly, I would say, who would argue that we now need to consolidate the balance sheet of government and central bank. So we need to basically count the balance sheet of a central bank as a part of the debt for Japanese government. So, it's a complex issue. I hope my report was easy. Hopefully it's easy enough for readers to understand. But then if you read it, you will explain what Martin mentioned.
Also, I wanted to ask you, because I think it's the core of the issue relative to net debt relative to gross debt, is the fiscal trajectory, which I think matters more, because a lot of people confuse stocks versus flow. So there's a stock of debt, but what matters in the end is the flow. And when we look at Japan, when we look at its net international investment position, it's much more favorable than, let's say, the United States. As such, Japan appears to be one of the largest creditor nations in the world when it comes to the significant assets they have overseas. And what I wanted to check with you, to ask you, is about the primary deficit in terms of the budget, which is still around -2%. And given the new government which has arrived in Japan, it seems that they have some significant envies to increase the spending. And I would like to ask you, do you see any issues given what the Japanese government wants, what the Ministry of Finance would like, and what the Bank of Japan is trying to achieve? How do you reconcile those three differences?
So the current Prime Minister, Sanae Takaichi, so she's the first female Prime Minister of Japan. She became Prime Minister back in October last year. So it's been almost a year. But then I think she's been kind of criticized for being, preferring to have a loose fiscal policy. Well, what I will say is all politicians, they like to spend, right? So all politicians generally prefer loose fiscal policy. So in that sense, she's no exception. So I do wish it's better for the health of Japanese sovereign credibility if she becomes a little more prudent in the way she manages, government finance. But I do believe that the Japanese government should pay more effort to consolidate its fiscal situation. But having said that, I think we need to basically consider that many shades of gray. Yes, they are spending, but how much they're spending is another issue you need to consider, right? So I think when all things considered, I think I am actually okay with Sanae Takaichi's fiscal policy in a sense that it's kind of it's a acceptable, political price to pay for being popular. So, but on the other, so and as Martin said, fiscal balance is still around 2% deficit to GDP. So that's kind of manageable so long as Japan keeps growing and interest rate is low. So for US, it's a different issue, right? Thanks to what they call big beautiful bill, the deficit did grow sizably in US, and interest rate is high. Policy rate is close to 4%. Bond yield is higher. So US is suffering from a higher interest payment. And okay, this is so you guys are European, so this is a subject you may not be happy to talk about. But there's also a problem on the continent. Well, also on the European side. Yes, there's some problem in UK, but then I do think France and Italy are having some fiscal issues. And the problem for this Euro area countries, as we saw in the Euro crisis, is they have a shared central bank, right? So U.S. Federal Reserve, they are dedicated for United States, right? Bank of Japan is dedicated for Japan, but then ECB, they are dedicated for the Euro area as a whole. They are responsible for German population as much as they're responsible for Italian and French population. So, ECB just can't decide the best policy for France or Italy. So that's basically, in very short term, in very, very simplistic term, that's basically how Euro crisis came about. This political game they need to play for the central bank to take the best policy at the time. So I think Draghi did fantastic job as a central banker. I admire him very much. But then I think there is a structural issue, or in a Euro area whenever they have start to have some fiscal problem.
But it has been resolved in some of the European countries. If I take, for example, Portugal now has a very significant excess primary surplus, which explains why the debt to GDP, in fact, is falling quite rapidly. Greece still has a deficit of around 2% primary, but the debt levels are coming down as well quite significantly with the acceleration of the economy. Spain as well is enjoying some nice bounce. The only country, when I look at structural reforms, which hasn't done nothing, in fact, it's my own country, is France. But that's another subject.
Yeah, and the Germans are not much better over the last years. So.
But returning to Japan, what I think was very interesting from another paper I read is that the Japanese government has shown remarkable ability to hold down per capita expenditures on both social pension and healthcare, which has enabled fiscal sustainability of the debt trajectory of Japan. And also, Japanese government, they have shown remarkable ability to raise tax substantially, which has enabled Japan to navigate this very deflationary long period it went through. And it seems to me, might be wrong, but finally it seems that Japan is about to turn the corner of that very deep deflationary period. So as such, what we've been seeing is that the policy of the Bank of Japan has resulted in a dramatic decline in the amount of the government bonds, which were held by the private sector. And I think people don't realize that there was a transfer of liability from the private side to repair the balance sheet to the public side, which this big issue was taken full on by the Bank of Japan.
So balance between the growth rate and interest rate is helping Japan. So in Japan, interest rate, policy interest rate is 1%. At the long end, it's much higher, roughly close to 4%. So, you do need to think about, basically on average, when it comes to the interest rate burden. But then on average, Japan's growth rate, nominal growth rate, is significantly higher than the average interest rate. So in that sense, the time is helping Japanese government, at least for the next 4 to 5 years is concerned. And another issue is it's interesting about the tax, but basically tax brackets tend to be defined at the level, right? So every year, because of the inflation, your income rises, right? So even though it's just an inflation, so in the real term, your income is remain unchanged. But from a taxpayers tax paying point of view, because you are crossing the threshold, right? So 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 basically, with inflation, there's actually a tendency for the effective tax rate to rise,
Yeah,
and
it's
the
called the bracket creep. In
yes,
economy, we call it the bracket creep.
yes.
Absolutely, yes.
Yes. So Japan is actually enjoying the bracket creep as well as this inflation. Inflation is a tax, and the Japanese population, I think they've been so used to 0% inflation, so they are not really realizing that the inflation is costing them. Yes, it's low, it's 2%, but so but so I think if Japan were much smaller, say underdeveloped countries, we could be seeing kind of flight over capital, capital flight.
Yes.
Yeah, because of the inflation, Japanese population could be moving the money, into euro, US dollar, or maybe China. But then since inflation has been so stable in Japan, I think Japanese population are, they basically forgot the fear of inflation. So that's something Japanese government is still counting on.
Also, I wanted to ask you as well. I think what's been very helpful for Japan, it seems to me, was the very, very tight control on the government expenses as share of GDP, which is a much lower basis. For example, if I take European countries and in particular France, which is at a record level, which is for me personally not sustainable. And as such, Japan has a much, I would say, a bigger opportunity given the tight control of government expenses to escape this deflationary trap than some European countries, which are coming from a much higher basis of government expenses relative to GDP.
Mm-mm-mm. So it's another subject which is worth, I would say, multiple reports. But Japan is kind of middle service, middle tax burden country. So in terms of expenditures on education, expenditure on social service, Japan is basically in the middle between majority of European countries and US. So I think Japan, many people actually have been criticizing Japan for spending less on education. So it's something. I think Japan is kind of famous for being kind of studious and
Disciplined.
yes, but then it's actually not thanks to that level of education in Japan. It's not thanks to government spending a lot of money on education, but it's more of a cultural thing. So coming back to your questions, yes. So Japanese government is paying less for its kind of social infrastructure. So that's also helping. So, but then like Japan does have a fiscal deficit, right? So Japan
Yes.
doesn't have a luxury of spending more on social expenditure.
Okay. Also, I wanted to discuss with you as well this big discussion surrounding the end of the carry trade. What has been highlighted is the risk of repatriation risk rising, given that the Ministry of Finance has been slowly nudging the government pension fund, the GPIF, and the large Japanese insurance life companies to repatriate their overseas holding and to invest domestically. And everyone is looking at this with great concerns, given the size of the net international investment position of Japan, which represents around 90% of GDP, which is the total contrary of the situation of the United States, where the net investment international position is around negative 90% of GDP. So I wanted to discuss with you what are the implications? What are the risks? Are they going to materialize? Is the Ministry of Finance has a deep impact and a potential impact of the GPIF and the lifers?
Mm-mm-mm. So again, this is a huge subject, and it's a very global. It's a subject of global interest because now we are talking about the dominance of a U.S. dollar, right? So one reason why United States owed so much to the rest of the world is basically they are letting their currency, treasuries, US dollar, be used as a global currency, right? So that's why the rest of the world has so much treasury and USD, because they're actually using it for the international trade. So so I think that's actually important issue we need to keep in mind, right? So US government owing to the rest of the world is kind of by design. Okay, so coming back to Japan and the GPIF, now we are kind of more of a smaller issue on a global term. But then, yes, so currently GPIF, so Japan's public pension fund, they allocate 50% of their asset into foreign equity and foreign bonds. And if you were UK, I think this kind of allocation may make sense. I think UK is much closer to the continental Europe. They trade more, so it kind of makes sense for their asset over the pension to be more diversified. But Japan is actually a fairly domestic country, right? We don't really so our price are mostly all in yen, and so I think GPIF used to actually invest nearly 70% of their total asset into just government bonds. So, but over the last 20 years, GPIF has been kind of shifting their asset to foreign currency. I do believe this was actually a part of a kind of strategy for Japanese government to, induce yen weakness to some extent. And they also knew that, Japanese equity, government bond, the expected return on them were low, right? Especially under the Bank of Japan's, yield curve YCC policy, right? Who would buy a 10-year bond at the 0.1%, right? So I think a public pension fund portfolio manager made the right decision to basically lower the weight of a government bond and increase the weight of a foreign equity and foreign bonds, 50%. But then as a pension, given all your liability are in yen, I think allocating 50% to foreign equity and foreign bond can be argued as not optimal. It's a bit unusual. And obviously, given the low interest rates on bond, maybe unusual circumstances required unusual weight. But then now that government bond is yielding a fairly fair interest rate, so after the hedging for the currency, Japanese 10-year bond at the 2.8, 2.9% is actually equivalent to 10-year US bond after hedging, after the hedging cost. So it actually does make sense for portfolio manager, for pension portfolio manager in general, and especially the government pension fund, to think about kind of correcting your weight. So I think that's about GPIF. This is not just a kind of government meddling in the affair of public pension fund. So I think there is actually a legitimate reason to consider reweighting pension asset back into yen.
And would they invest into bonds in Japan or also into equities? So, or is it a mix?
So equity people seems to be, they have very optimistic way of thinking. So whenever something happens, they like to think it would benefit equity. Why not? But then I think, well, I mean, to be fair, you're talking about pension, right? So, and Japan is actually fairly aged. It's a very mature demography. So it's not like so Japan is basically managing a pension fund for the average year of 60 years people, right? Not for people in the 30s. So I think there is a reason to think that, pension funds should be more conservative, so that more weighting should be put in bond rather than equity. But then
certainly the yields are the yield argument in that age, if you have like a pension fund with that age structure, so it makes sense. So.
Yeah. But it's a complex issue, and I don't want to make any kind of any bold prediction without any evidence. So,
but it's a process that will start for sure, given the quantitative tightening and the steepening of the Japanese yield curve. And obviously, if you are an insurance company, even in Japan, you start considering investing in the long end because it makes sense with normalization of the policy rate. The question, I think, on everyone's mind is what's the time frame? How is it going to happen fast? How is the weight how the weight is going to evolve in the next couple of quarters of years? I think it's on everyone's mind. As well, there was a question raised given the significant divestment and reduction of the Bank of Japan US Treasury's allocation. And it seems to me, I might be wrong, but it seems to me that they had decided to reduce the duration exposure to US Treasuries. And as such, it seems to me that they've put some pressure on the US yield curve, which created some steepening pressure, hence the reaction of Besant, which came to the market to sell euros. I wonder what you think about this.
So duration composition of Japan's FX reserve is not disclosed, but then but then they have disclosed some details in parliament sessions. So I think the majority of the U.S. Treasury holding is in U.S. Government notes, less than 5-year maturity. So they tend to be on a kind of a shorter end anyway. But then what Japanese government has been doing for the past, say, a year or two is they have been preparing for the potential FX intervention. And for the FX intervention, it's you better have cash, right? Because you're selling US dollar cash and then getting yen back. So and obviously if well, I think FX reserve. I think we're still talking about 1 year, 2-year bond, so its duration is still relatively short. So Japanese FX reserve setting 1 year U.S. Treasury shouldn't have that much of a market impact. But then to be politically, it's a politically sensitive subject. So Japanese government were basically allowing U.S. Treasury bond to mature and not kind of reinvest. So I think that's maybe what kind of trickled Scott Besant's mind. He sees that Japanese government is buying less U.S. Treasury. Why? So that could have been the reason for the U.S. government joining FX.
Okay, Zoltan, you have any questions relating to some market factors?
No, I think we are nearing our 1 hour of macro. I don't know. Takuji, do you have anything to add? What
Yes,
you would like to add on Japan?
actually, so relating to the subject we just talked about, so there's this big grand idea of US dollar losing its dominance over financial system. So this is something which will not happen in like a year or two. We are talking about few decades long trend. But then I think Japanese government's recent FX intervention, I think it can be a kind of a sign that the Japanese government realizes that their FX reserve is being too heavily weighted on US dollar. FX again, Japanese FX reserve currency decomposition is not disclosed, but then it's generally thought to be heavily invested in USD, 90%. But then in the last, say, 20 years, 20, 30 years, the weight of US dollar on global FX reserve has been declining. Late 70s, it was as high as 80%. It's now 56%, according to my recent calculation. So Japan is still owning, weighting 90% of its FX reserve on US dollar. So, and compared to the global average of 56%. So I think it actually made sense for Japanese FX reserve to kind of lower its weight on US dollar. But then in terms of historical context, I think it's actually a very interesting phenomenon.
Thank you very much, Takuji. And do you see the Japanese yen versus the dollar strengthening or continue to weakening? Because it's been the question on everyone's mind, given the significant FX intervention we have seen in recent years.
So this is a very touchy subject, but in terms of, so I think there are many ways to estimate the fair value of exchange rates. But then one aspect, one measure is called PPP, power purchasing parity measure. The Economist magazine called it, they have a Big Mac index, right? So they measure the price of Big Macs.
Yes.
to come up with a fair value. So on these PPP, yen is heavily undervalued. So there are reasons why yen has been undervalued. Big capital flow, like we talked about. There has been a huge money flow from Japanese household and also public pension fund toward non-yen assets. So all this
Yes.
capital flow has been kind of driving yen down. So there has been kind of long deviation from PPP based fair value. But then we need to always keep in my mind, it's a deviation. And at some point, it's more likely that the value of yen would go back to the PPP. I think that has been, so it's difficult to say when, and it can take a very long time. Many economists, great economists have studied this subject. But then usually it tends to revert to the PPP fair value.
Thank you very much for these explanations, Takuji.
Pleasure.
Also, thank you very much for joining our 1 hour of macro. And I think it was very insightful. It was insightful for me, and it will be insightful for our viewers.
Absolutely. And we
Thank
will not hesitate to put the link to your Substack, Japan Macro Advisors, within the description of the video, which will be published.
Thank you so much. And it's been a pleasure. Thank you.